There's a moment in every market cycle where one asset sits completely ignored, not because it is broken, not because the fundamentals have fallen apart, but simply because something shinier is grabbing all the attention. And right now, we are living inside one of those moments. The question you need to ask yourself today is not whether you have heard of this opportunity. The question is whether you will act on it before the rest of the market wakes up and the price of entry is gone forever. What you're about to hear covers one of the most significant setups in the market right now, a story that touches SpaceX, Ethereum, super microcomputer, and a broader shift in how financial assets are going to be owned and traded in the next decade. These are not small ideas. These are the kinds of ideas that, when you look back 5 years from now, you will either say you were early or you will say you wish you had been. So stay with me here, because this is going to be worth every single minute. And if you are new here, do yourself a favor right now and hit that subscribe button. At Ticker Hawk, we break down the market every single week in plain English. No fluff, no filler, just the analysis that actually helps you make better decisions with your money. Hit subscribe and turn on the bell so you never miss an update. Now let us start with the one name that has been impossible to ignore over the past 2 weeks, SpaceX. The company went public under the ticker SPCX and immediately jumped roughly 19% from its IPO price, with shares continuing to climb even after hours on its first day of trading. That kind of opening move puts the company's valuation in the range of $2.1 trillion, which is a number that very few companies in the history of the market have ever touched. But here is where things get genuinely interesting, and also where most retail investors make their biggest mistake. The history of IPO stocks is not pretty. Research from the University of Florida looked at nearly 6 decades of data and found that close to 60% of stocks that go public are trading below their first day closing price after just 3 years. And if you narrow that down specifically to tech IPOs over the past decade, the numbers get even more sobering. Out of 27 major tech IPOs studied, 15 were lower than their debut price after just 3 months. And after 6 months, that number climbed to 21 out of 27 trading in the red. Think about that for a second. These are not obscure companies. These are hyped, talked about headline-grabbing names, and the majority of them disappointed early investors who bought in at the peak of the excitement. One of the most famous examples is Twitter. On day one, it surged 72%. People were ecstatic. It felt unstoppable. And then, over the next 6 months, it gave back 31% of that first day gain. The pattern is painfully predictable in hindsight, yet investors repeat the same mistake because the excitement of an IPO feels different from every other investment decision. And now, I want to be clear. I'm not saying SpaceX is going to follow that same path. In fact, there are some very specific structural reasons why the situation might play out differently. The moment SpaceX gets included in major indexes like the NASDAQ 100 and the Russell, which is expected based on the timeline of its listing, the demand for its shares from ETFs and index funds could be enormous. Any fund that benchmarks itself against those indexes is effectively forced to hold SpaceX in proportion to its weight in the index. If they do not, they are making an active bet against the stock, which most institutional managers simply do not want to do. When you add up the math on that index inclusion demand, you are potentially looking at around $14 billion in forced buying within just the first 15 days of trading. And if SpaceX eventually gets added to the S&P 500, which would be a massive milestone, ETFs that track that index may need to absorb as much as 43% of the available float. That is not speculation. That is just how index mechanics work, and it represents a very real support structure underneath this stock that most IPOs simply do not have. That said, there is a date circled on every smart investor's calendar right now, and that is August 11th. SpaceX has a standard 60-day insider lockup period, which means that starting around that date, early insiders and employees who received shares before the IPO will be legally allowed to sell. Markets almost always get nervous in the weeks leading up to a lockup expiration because investors start pricing in the fear of a flood of selling. Whether or not that selling actually materializes in significant volume, the anxiety alone tends to create downward pressure on the stock. So if you are thinking about SpaceX, that August window is something you absolutely need to have on your radar. And just to show you what can go wrong, even with a wildly oversubscribed IPO, look at Sarah Systems, ticker CBRS. 5 times oversubscribed, priced at $150, rocketed 133% on day one to close at $350, then lost 38% of that value within weeks. SpaceX had 4 times the subscription demand and opened with a more measured 20% gain, which is actually healthier. But the lesson is clear. Hype alone does not protect you from gravity. Now, let us shift over to a name that has been on a wild ride lately, super microcomputer, ticker SMCI. If you have been watching this stock, you know it surged back up toward the $50 level earlier this month before pulling back sharply, down roughly 40% from that recent high. The initial selling came from a broader tech sector pullback. But then, the company added more fuel to the fire by announcing plans to raise up to $7 billion in new shares to fund the costs of fulfilling a backlog of server orders that has now reached $39 billion. That announcement spooked a lot of investors and the stock dropped hard. Here is the thing though, and this is where you have to separate the noise from the signal. The reason Supermicro needs to raise that capital is not because the business is struggling. It is because the business is growing faster than anyone expected. A $39 billion order backlog does not happen to a company whose product is unwanted. It happens to a company that cannot build its product fast enough to meet demand. Yes, ideally, a company funds its growth through its own cash flow rather than diluting shareholders. But when demand is growing at this speed, raising external capital to keep up is not a red flag. It is actually a sign that the AI infrastructure build-out is as real and as powerful as the bull case suggested. And Supermicro is not alone in this dynamic. Oracle dropped at 11% when it announced plans to raise $20 billion in equity financing. Alphabet has committed $80 billion to fund its own AI build-out. These are not struggling companies issuing distress capital. These are dominant businesses trying to capture as much of a generational opportunity as they possibly can before the window closes. That context matters enormously when you're deciding what to do with a stock like SMCI sitting around $30 a share. If you're finding this breakdown useful, drop a comment below and let me know which of these stocks you're currently watching or holding. The Tickerhawk community is one of the most engaged finance audiences on this platform, and I genuinely read what you all write down there. And if you have a friend who talks to you about investing, share this video with them. It might be the most valuable 13 minutes they spend a day. Now here is where the conversation gets really important. And honestly, this is the part I want you to pay the closest attention to, because it connects everything else we have talked about today. While most investors right now are either chasing AI stocks or trying to figure out the SpaceX IPO, there is a much bigger structural shift happening underneath the surface of the financial system. And that shift is called tokenization. Tokenization is the process of taking a real-world asset, a stock, a bond, a piece of real estate, even a money market fund, and representing it digitally on a blockchain. The blockchain becomes the official, transparent, tamper-proof record of who owns what. And once an asset is on-chain, it can be bought, sold, or transferred in seconds at any hour, anywhere in the world, with a fraction of the fees that traditional financial markets charge. This is not a startup pitch or a white paper fantasy. This is already happening at scale right now. JP Morgan is already tokenizing treasury bonds inside a $30 trillion market. The NASDAQ exchange is actively working on tokenizing stocks listed on its platform, stocks that together represent $127 trillion in market value. JP Morgan is also tokenizing money market funds inside a $4 trillion pool. And perhaps most significantly, Bank of America, JP Morgan, Citigroup, and Wells Fargo are all collaborating on a tokenized deposit network that would put your actual savings deposits on a blockchain. These are the biggest, most conservative financial institutions in the world, and they are all moving in the same direction at the same time. The CEO of BlackRock, Larry Fink, who manages more money than almost any other person on the planet, has said plainly that every stock and every bond and every asset can be tokenized, and that this will fundamentally change how investing works. Right now, roughly $30 billion in assets have already been tokenized globally. That sounds like a big number until you compare it to the $270 trillion global equity and bond market, or the $288 trillion real estate market where tokenization would be particularly powerful. We are at 0.01% penetration. The tokenization market is growing at 200% per year. You do not need to be a math genius to understand that the gap between where we are and where this is going is absolutely enormous. So why does any of this matter for your portfolio right now? Because the network that processes more than half of all tokenized asset transactions in the world today is Ethereum. Think of Ethereum not as a speculative cryptocurrency, but as the highway system on which the future financial economy is going to run. Every time a tokenized asset changes hands on that network, a fee is collected, and it flows back to the network. The on-chain data tells this story very clearly. Daily transactions on Ethereum have doubled compared to last year. The number of smart contracts deployed on the network, and every tokenized asset requires a smart contract to define its rules of ownership, has jumped 29% year over year to 89 million total, and has doubled over the past 5 years. These are not price chart patterns or sentiment indicators. These are real-world usage metrics showing that the tokenization revolution is not coming. It is already here and it is accelerating. Now here is the honest part of this conversation. Ethereum has been one of the worst performing assets of the past year. While AI stocks like Nvidia have been delivering extraordinary returns and capturing all the headlines, Ethereum has been crushed. A lot of that is simple human psychology. Investors are not going to hold an asset that feels like it is going sideways when something else seems to be going straight up. But this is also precisely the pattern that creates the opportunity. Assets get ignored not because they stop working, but because something else temporarily captures more attention. And when the ignored asset has genuinely strong fundamentals underneath it, real usage, real institutional adoption, real structural tailwinds, that ignored phase is exactly when the patient investor wants to be building a position. If the tokenization market grows to even $3 trillion, which would still be less than 1.2% of the total addressable market, that would represent a 100-fold increase from where it is today. Ethereum's previous all-time high was around $4,900. A 100-fold increase in the market it serves would likely push Ethereum well beyond that. Some analysts have put forward targets of $10,000 or more in a full tokenization boom cycle. Even if the reality is half of that, you are talking about an asset that could deliver a 6 times return on your money from current prices. That is why the title of today's video says what it says. The key to investing in Ethereum intelligently, especially if you're not comfortable buying cryptocurrency directly, is that you can now access it through regulated ETFs. The iShares Ethereum Trust, ticker ETHA, and the Grayscale Ethereum Mini Trust are both legitimate regulated products that give you Ethereum exposure without needing to set up a crypto wallet or navigate an exchange. For investors in the 45 to 55 plus range who want the exposure but prefer to stay inside the traditional brokerage account structure, these ETFs are worth understanding. They trade just like a regular stock, and they give you direct participation in Ethereum's price movement. And while you are holding and waiting for that larger move to develop, there are also ways to generate income on your position. Selling covered call options against ETF holdings like ETHA is a strategy experienced investors use to collect premium while the longer-term thesis plays out. It does limit some upside, which is why most apply it only to a portion of their position. But as a way to stay patient and get paid while you wait, it is worth understanding. Before we wrap up, let us talk about the broader market environment because it sets the backdrop for everything else we have discussed. Inflation data has come in hotter than a lot of people expected. Consumer prices are running at 4.2% year over year, and producer prices, which tend to lead consumer prices, are up 6.5%. Those numbers have effectively taken any near-term Federal Reserve rate cut off the table. And markets are now beginning to price in the possibility that the Fed might actually need to raise rates further before this is over. The UK already moved in that direction, becoming the first major central bank to hike rates in this cycle. And that move sends a signal about where global monetary policy might be heading. The new Federal Reserve Chair's first official meeting is coming up this week, and the language that comes out of that meeting is going to matter. If the Fed signals a more aggressive stance on inflation, you could see pressure on tech stocks and growth assets in the near term. But if the new chair takes a more measured tone and signals that the Fed is willing to be patient, that would be a meaningful positive for stocks and risk assets broadly. The market has largely priced in a tough Fed tone at this point, which means a slightly softer message could actually be a positive surprise. Either way, this is one of the most important macro moments of the year, and it is going to influence how every asset we talked about today trades over the next several weeks. The thread that runs through all of this, SpaceX, supermicrocomputer, Ethereum, the tokenization boom, is that we are living through a genuine restructuring of how the economy works. AI is changing how decisions are made. Tokenization is changing how assets are owned and transferred. Space infrastructure is changing global communications economics. These are not short-term trades. They are structural shifts that take years to play out, and investors who position themselves during the ignored phase, before the mainstream catches on, capture the biggest returns. If you made it this far in this video, I genuinely appreciate you. A lot of people click on a video and leave after 90 seconds. You stayed, and that tells me you are serious about your financial future. Do me a favor, if any part of this breakdown was useful to you, hit the like button right now. It takes 1 second, and it genuinely helps more people find this content. And if you have a specific stock or sector you want us to break down next week, put it in the comments below. We rate everything, and we build our content around what this community actually wants to learn about. The market rewards patience, preparation, and the willingness to look at what other investors are ignoring. Right now, several of the most important opportunities in the market are sitting in exactly that ignored zone, and the window to act before history repeats itself does not stay open forever. Stay sharp, stay disciplined, and we will see you in the next one right here at Tickerhawk.